Welcome back to the Deep Dive. We're here to cut through the noise and give you the insights you need. Today, we are really diving deep into the technology sector. I mean, it's undeniably the backbone of the modern global economy, wouldn't you say?
Oh, absolutely. It's more than just a sector, really. It's this whole foundational ecosystem. It shapes everything, how we talk, how businesses run. We're talking semiconductors, software, social media, and yeah, the really big one now, artificial intelligence. It's just huge. The market cap is sitting around, what, $19 trillion?
19 trillion. That number alone explains why everyone's so interested, right? Tech stocks, they've got this history of just incredible returns, massive growth potential. But here's the flip side, the paradox we need to talk about. It's also probably the most volatile part of the market. Things change so fast.
They really do. Innovation, disruption, it's constant. And that makes it, well, pretty challenging for investors, especially if you're just starting out. It's high stakes, and it moves incredibly quickly.
But those returns.
Yeah, exactly. That potential payoff is why people jump in. Our sources, they really highlight this historical outperformance. Get this. Between January 2017 and June 2025, the tech sector, it returned a massive 441.79%.
Wow, 441%. That really grabs you.
Yeah, and compare that to the S&P 500 over the same time, just 151.14%. The difference is, well, it's dramatic.
Okay, so there's the potential. Let's unpack this for you, the listener. Our goal here is to give you a kind of shortcut, right? To get you well informed about investing in tech. We basically boiled down the research into 10 key tips. Think of them as guardrails to help you harness that potential, but also, crucially, manage the risk that comes with it.
Okay, so first things first, you have to understand the landscape right now.
Yeah.
And honestly, it's dominated by just a few massive players, this magnificent seven group: Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, maybe Broadcom or Tesla, depending on the day.
Right, and the sources point out that as of May 2025, just that small handful of companies makes up something like 30% of the S&P 500's total weight. That's a lot of concentration.
It's unprecedented, really. And that leads us perfectly into our first guardrail, our first tip. You absolutely must understand the specific risks in tech. Really understand them. Concentration is part of it, sure. But the real kicker is the sheer speed of change, the volatility.
Yeah, I get that. It's not just like normal competition. It's the risk that some new tech just makes an existing business obsolete almost overnight.
Precisely. So trying to pick stocks, especially in these super fast-moving areas like, say, generative AI, it's incredibly hard. Today's leader could genuinely be wiped out tomorrow by, I don't know, a new open source model or some startup that comes in with a totally different cost structure. Our sources basically say, look, predicting the winners 3, 5, even 10 years out, it's almost a fool's game unless you have really deep specialized knowledge of that specific niche.
And it's not just the tech itself changing. There's the whole regulatory side too, right? Governments are always looking at tech companies.
Oh, yeah. Data privacy is huge. Antitrust actions are becoming more common. There's global pressure on how emerging tech is used. It's a constant battleground.
That's a big layer of risk.
And don't forget the environmental and social side. There's growing concern about the energy data centers consume, the whole e-waste problem.
Which means ethical investing isn't just about feeling good anymore. If the public or regulators start pushing back hard on companies with poor environmental or social records, that becomes a financial risk too.
Exactly. So avoiding companies that clash with your values or actively seeking out ones that align, it's actually a form of risk management now. You're potentially avoiding future backlash or penalties.
Okay, so risk awareness is job one. Let's shift to the actual homework you need to do before you invest. This brings us to tip 2. Know which metrics to actually look at beyond just the excitement.
Right. You can't just get caught up in the hype about some amazing future product. You need to look at the company's actual financial health now.
The fundamentals. So we're talking things like revenue growth. Is it consistent? Profit margins, are they healthy? Is the company generating actual cash?
Yes, all that. And of course, the classic price-to-earnings ratio, the PE. It helps you gauge if the stock price is, reasonable compared to its current profits.
But you mentioned tech is different. Standard metrics aren't always the whole story, are they?
Not always, especially for software, streaming, social media. You need to look at some non-traditional metrics too. Things specific to that industry, like monthly active users, MAU. That's huge for social media or subscription software.
Okay, why MAU? Why does that matter more than, say, current revenue for some of these companies?
Good question. It's because MAU is often a better leading indicator. It shows market share, long-term potential. especially if the company's main goal right now is just growing its user base, not necessarily making huge profits yet. A giant user base suggests strong network effects, right? The platform gets more valuable as more people join. That future potential is often what justifies a really high valuation, even if profits aren't great today.
Got it. That makes sense. It's about future potential baked into the user numbers. All right, let's talk financial health checks. Starting with the short term, tip 3 and 4 are about stability. Let's start with liquidity.
Okay, liquidity. Simply put, can the company pay its bills over the next 12 months? Can it meet its short-term obligations? And this is really critical in tech because things change fast. A company might need to suddenly pivot its strategy, invest heavily in a new area because of a competitor, or deal with a new regulation. They need cash on hand to do that.
So how do we measure that? What are the key ratios?
The main ones are the current ratio and the quick ratio. The current ratio looks at all current assets versus current liabilities. Pretty straightforward. But the quick ratio, that's often more insightful for tech, that does the same thing but excludes inventory of the assets.
Why take inventory out?
Because for a lot of tech companies, especially software or digital services, inventory is tiny or non-existent. It's not like a car maker with lots full of unsold cars. You really want to see if their cash, the receivables money owed to them, and any easily sellable investments can cover their immediate debts. Generally, if those ratios are above 1, it suggests they have enough breathing room for the near future.
Okay, so they can survive the next year. Now, what about the long haul? Their ability to keep growing, maybe aggressively, that brings us to solvency, tip number 4.
Right. Solvency is about meeting obligations beyond the next 12 months, long-term health. And tech companies, well, they're famous for using debt, borrowing money to fuel that super fast growth, which is fine, even necessary sometimes if it's managed well. But too much debt, that dramatically increases risk, especially if interest rates go up. Suddenly servicing that debt becomes really expensive.
So we look at ratios like debt to equity and debt to assets, DA. But is a high DE ratio always a red flag for a tech stock?
Not necessarily. And this is where the nuance comes in. Context is key. A really high DE for, say, a stable utility company, that might be alarming. It suggests instability. But for a fast-growing tech firm, a moderate or even somewhat high DE ratio could actually be a sign they're using debt smartly to grab market share quickly. The crucial thing is, you must compare these ratios only to similar companies in the same specific tech niche. Don't compare a software as a service company to a chip maker using some broad tech sector average. It's misleading.
Context, context, context. Got it. Okay, let's shift gears a bit. Away from the company's internals to external factors. Tip 5. Track earnings guidance and analyst forecasts.
Yeah, this is important. Every public company gives guidance, their own prediction for future earnings. And then you have dozens of Wall Street analysts publishing their own forecasts. These estimates really move stock prices. A company beats expectations even by a little. The stock often jumps. They miss. It usually falls.
But we already said tech is volatile and hard to predict. So how do you avoid getting swept up by overly rosy predictions, especially from the companies themselves?
You have to be a bit skeptical, Look for consistency. Be wary if the management seems to be prioritizing growth at any cost without a clear path to actual sustainable profits. If their whole plan seems to depend on raising tons more money later or just endless hype without showing they can execute, those projections are fragile. That can lead to dangerous overvaluation.
Makes sense. Be wary of growth at all costs narratives. Okay, that leads nicely into tip 6. Stay informed on broader sector news and economic shifts. It's not just about your specific stocks.
Absolutely essential. Tech doesn't just change. It goes through these massive shifts, these revolutions sometimes. You need to keep track of big regulatory moves, global economic trends, and of course, major tech breakthroughs. Like right now in 2025, AI, machine learning, automation, this stuff is changing everything, almost every industry. You need to have a sense of which companies are leading that charge and which might be getting left behind.
So the key is having that wider lens, understanding the whole tech climate, not just your little corner of it.
Exactly. And you can use technology for this too. Most brokerage platforms have tools now, real-time news alerts you can set up for specific sectors or themes. It's vital for staying ahead of potentially market-moving news or disruptions.
Right. And related to the company itself, tip 7 is about studying the leadership, the people actually running the show.
Yeah, we talk a lot about the tech, the products, but the management team, their vision, how adaptable they are, their track record, that's critically important for long-term success. Sometimes you get these iconic leaders like Steve Jobs or Elon Musk who practically become the brand. That can build huge investor confidence. But Even beyond those big names, you should research the whole management team. What's their background? Have they successfully executed big strategies before? Listen to how they talk on earnings calls and interviews. What's their vision? How credible does it sound?
Good point. The human element is key. Okay, last few tips, focusing on core investment strategy. Tip 8. The classic advice, diversify your portfolio. But you mentioned tech needs a bit of an asterisk here.
It does. Because the temptation, especially lately, is to just load up on those magnificent 7 stocks. They've done so well, right? But piling into just a few hot stocks is a classic mistake, especially for newer investors. That's over-concentration. Even the absolute best companies can hit unexpected problems, a regulatory crackdown, a sudden market shift, a black swan event. If your whole portfolio is tied to just a few names, you're incredibly exposed.
Okay, but hold on. If you said earlier those 7 stocks are like 30% of the S&P 500, doesn't just buying a broad index fund like an S&P 500 tracker mean I'm still highly concentrated in those same tech giants?
That's a really fair point. And yeah, it's true that broad market indexes are heavily weighted towards big tech right now. You can't completely escape that concentration by just buying the index. However, buying the index fund still diversifies you across all those leaders, plus hundreds of other companies. It protects you from the catastrophic failure of any single one of those big tech names. So if you want tech exposure without trying to pick individual winners and losers, an index fund is still a very efficient way to start. It mitigates that single stock risk, even with the heavy weighting.
Right, okay. It spreads the bet across the leaders, even if the leaders dominate the index. That makes sense. All right, tip 9. Follow a long-term investment strategy. This sounds simple, but maybe it's harder in tech.
I think it is harder in tech, honestly, because the sector is so fast-paced, so reactive. Every headline, every little product update, every analyst upgrade or downgrade, it feels designed to make you react, to make impulsive, emotional decisions.
Which usually means chasing stocks when they're hot and panic selling when they dip. Buying high, selling low.
Exactly the wrong thing to do. In this case, emotional discipline is maybe just as important as the financial analysis. Real success usually comes from setting a clear, long-term strategy based on your own goals and risk tolerance, and then sticking to it, tuning out the daily noise.
Easier said than done, but crucial. Okay, final tip, number 10. And there's some nice irony here. Use technology itself to help you invest in technology.
Yeah, I like that framing too. You're betting on tech innovation, so why not use tech's own tools for your investing? Modern platforms offer some really powerful features now. Things like automatic portfolio rebalancing, advanced stock screeners setting up rules like predetermined criteria for when you might buy or sell a stock.
Tools designed to take the emotion out of it, basically, to enforce that discipline we just talked about.
Precisely. They help you stay objective. And this area is moving fast, too. We're seeing AI-managed ETFs now, robo-advisors powered by AI that are getting really sophisticated. They use machine learning to analyze data and execute complex strategies, often way faster and more objectively than a human could.
Okay, so let's wrap this up. 10 tips, 10 guardrails. The core message seems to be, yes, the tech sector offers potentially amazing growth. That 441% return figure sticks in my head, but capturing that potential safely.
It requires work, careful analysis of the fundamentals, really understanding the market dynamics and risks, making sure you're diversified, and having the discipline for a long-term view. It's about balancing that disruptive potential with smart risk management.
Absolutely. And building on that last tip about using tech, here's maybe a final thought for you, the listener, to chew on.
Yeah, think about this. As AI gets more integrated into investing tools, these AI-managed funds, smarter robo-advisors, how might actually using these advanced technologies give you an edge? Not just an edge in the tech sector, but potentially an edge over other investors who maybe aren't adopting these tools as quickly.
That's a powerful thought. Maybe exploring those emerging AI tools is your next deep dive after listening to this. Thank you for joining us today. We'll catch you on the next deep dive.